With that, I want to introduce you to some friends and leaders in the space finance sector. Meagan Murphy Crawford, who is a co-founder of SpaceFund. And SpaceFund is a venture capital fund investing in space startups. So I think they're gonna be presenting capital landscape from the VC perspective.
Today I want to talk a little bit about, as Dan mentioned, the technologies, the areas of interest, but I wanted to give a little briefing about the economics of venture capital. So I see venture capital as the fuel, right? This is what actually gets the rocket moving, okay? So we see ourselves as a catalyst, but our primary goal is to create value for our investors, right? That's who we have the fiduciary responsibility to. And so this VC capital takes these ideas through the valley of death to hopefully create profitable companies, right? And so then that's how we get capital back to our investors. And specifically in the space industry, we see that companies need to have both commercial and government revenue to really reach escape velocity and to see success. So where'd Bruce go? There's Bruce, space economics expert right there. Space is hard, economics is hard, space economics is even harder. So I thought you would appreciate that one, Bruce. Fundamentally, it's a numbers game. As Dan said, we don't do the more traditional VC approach of spray and pray, but fundamentally it is a numbers game. So most VCs have dozens, if not hundreds of companies in their portfolio. So these portfolio companies, we call portcos, and so most VC funds also have a 10-year fund lifetime with a 3-year investment period at the beginning of the fund. So that means there's only 7 years for these portcos to actually start producing results. And the general expectation is that 75 to 90%, and in some cases more, of these companies will completely fail. That means their valuation will revert back to zero. And so that means the remaining 10% of companies left in this portfolio of investments need to have exits at 100x the initial investment valuation in order for the portfolio of investments overall to be successful. If you are a startup company, and Dan talked a little bit about the valuations, making sure that your valuation is realistic, I like to do this math with potential portfolio companies and just kind of work our way backwards from what success looks like, right? So consider a startup company. They've got a seed round at a $5 million valuation, which is fairly reasonable for a lot of space companies. That company needs to be worth 100x in 7 years in order to make the VC math work, right? So can this company be worth $500 million in the next 7 years? And the way we kind of do that math is standard industry 7x profit or EBITDA is kind of, a lot of companies when they go public, their exit multiple is usually between 5 and 10. So for ease of math, we usually just use 7x. Okay, so that means you have to have $72 million in profit to have a $500 million valuation 7 years from now. Less than 1% of companies meet this criteria. So if you can't meet this criteria, don't feel bad. It means you don't have a VC-able business, but you still might have a great lifestyle business. And sometimes people take offense to that. And by lifestyle, I mean retire your parents and buy a boat lifestyle, okay? This is not necessarily a bad thing, right? But it just might not be VC-able. And so I think it's really important for founders to understand this math so that they don't have to get mad at Dan when he tells them their valuation is too high. So our basic thesis for the opportunities that we look for to invest in is utilizing the space environment to create value. We are a space fund, after all, so there's got to be a space component to the business for us to even look at it. Got to be a solvable problem, physics and engineering, as Dan discussed. And I think most of you may have heard of something called the tyranny of the rocket equation. I like to say the tyranny of the VC equation, which is what we've just been talking about. You've got to be a realistic exit candidate within 7 years with the potential to increase in value by 100x. Fundamentally, we focus on problems, which may seem a little counterintuitive, but the way I look at it is that problems equal opportunity. When there's a problem to be solved, there's an opportunity to make money. The first problem that we look at is what I like to refer to as LEO growing pains. As most of you are well aware, low Earth orbit is where the majority of satellites currently are. Small satellite revolution has really opened up LEO for business. The combination of, as you saw in Dan's charts, decreasing cost of launch, and then decreasing size of satellites has led to that hockey stick growth in the number of objects being launched into space. And the majority of these satellites are commercial, not government. Okay, that wasn't that way in decades past, but today most of them are commercial. So there's about 8,000 satellites on orbit. I don't know, when was the last Starlink launch? That number changes a couple times a week these days, but about 8,000 satellites on orbit. But we expect 100,000 to launch in the next 7 years. So this is one of those, you saw Dan's slide about how the cost has reduced by orders of magnitude. Now we're going to have the number of objects being launched into space increase by orders of magnitude over the next 7 years. And that's important because what's my investment timeline? 7 years. I always think it's stunning to look at the numbers this way. According to this data from May 2023, so this data is a year old, 89% of operating satellites are in LEO. 91% of them were commercial. This number is probably a little bit higher today, a year later, as far as what percentage of the satellites are commercial. This has led to some significant and serious growing pains. As a venture capitalist, as any type of investor, you love to see growth. Growth is exactly what you want. But the byproduct of that growth is these growing pains. So right now, most satellites are very limited in their power, computer processing and storage, and communications capabilities. That means there's opportunity there, right? They have limited lifetimes because of the drag of Earth pulling them back down. Extending lifetimes, there's another opportunity. And ride shares don't necessarily take satellites to their preferred orbital destination. As Bucky was talking about, sun synchronous orbit is great for some applications, but not for others. The first thesis point for our Fund 3 is what we call infrastructure. And this is going to be the largest portion of our portfolio by a wide margin. And we're looking for any technology or service model that can reduce cost or time to orbit and or increase profit and time on orbit. These are the subsectors of this infrastructure category that we have identified. I firmly believe that by the time we get to the end of our 3-year investment window, there's going to be a lot more subsectors here and more detail in each of these kind of sub-points. But these are primarily the things that we are looking for right now to solve those problems we just discussed. These are our existing portfolio companies and where they fit within these space infrastructure buckets. The second big problem that we see is beyond LEO, right? We've got all this activity going on in LEO, all this hustle and bustle, and we're solving all these important problems to make LEO cheaper and better. But now we're starting to see commercial industry push beyond LEO. For those of you who may not be aware, I love this chart. This is my favorite visualization of the primary different orbits. And I put the little moon in the corner because I don't want us to just think about these orbits. I want to start thinking about an entire cislunar economy. Beyond LEO, as I just showed that chart, HEO, MEO, but all the way out to the moon and beyond. Creating that cislunar economy is something that SpaceFund is very interested in supporting. And so we're seeing NASA, we're seeing DoD kind of lead the charge to push the industry further towards this kind of cislunar future. Global coverage from LEO may require hundreds of satellites, but you can get that same global coverage from GEO with 3 satellites. So now we're starting to change the economics of doing business in space if we can figure out how to make GEO, which is the most profitable location in the solar system right now, more affordable. Satellites typically have to be significantly larger to operate in LEO. They've got to be robust because it's a much harsher radiation environment. It's very remote. It's hard to communicate with. And so what we are looking for specifically is innovations that have pushed LEO businesses forward and how those can be applied to a GEO business model. Obviously moving out all the way to cislunar. CLIPS program has been phenomenal at kickstarting this cislunar economy. Intuitive Machines went public. We now have a public lunar company. That's amazing. If somebody would have told me that 10 years ago, I wouldn't have believed them. And so now we're starting to see these profit centers really develop in that cislunar environment. We're looking specifically at data and communications, habitable volume, Lagrange points as the strategic high ground, and maybe helium-3. Thesis point number 2 is beyond LEO. No more than 20% of our Fund 3 will go towards companies that are have technologies or service models that can make beyond LEO economically feasible and profitable, again, within the all-important 7 years. Here are some examples of some companies we've already invested in that are trying to solve some of these problems in the beyond LEO realm. Third problem, monetization of space data. People talk a lot about Earth observation, and Earth observation is fundamentally the majority of the reason that people go to space. But monetizing that data has been slow to develop. Climate change, climate monitoring, crop monitoring, shipping, human trafficking. How many barrels of oil are sitting at different ports around the world? These sorts of Earth observation opportunities can create value. And then when we talk about making life better for humans here on Earth, right? You got internet, you got TV, radio, videos of the Earth from space now coming back. And then manufacturing of products that can be useful to the everyday human here on Earth. I found this statistic to be stunning, and I double-checked it and triple-checked it and had somebody else check it to make sure before I started presenting about this a couple of years ago. Less than 1% of the data that's collected on orbit makes its way back down to Earth, or to analysts anyway. Okay, so and the analysts are the ones who drive the value creation from this data. Less than 1% of what's collected makes its way to the analysts. Even then, these are huge data sets still, and very, very difficult to analyze. So this limits the use cases or the monetization potential for this data, both by sales model and customers. Customers don't understand that this data is available or why it's valuable to them. The other real opportunity in this category is making stuff in space, utilizing the unique environment of low gravity, vacuum, near absolute zero temperature, and radiation. How can this be beneficial to create things in space that we can't make here on Earth? Most people are aware that protein crystals form very differently in space. This has applications from everything from fiber optics to biological manufacturing. And computer chip manufacturing requires this type of environment. Extreme precision requires this cold, airless environment. And what else? What are the thousands or millions of other products that could be created using this unique environment of space? The third thesis point is what I call space for Earth. No more than 15% of our Fund 3 will be invested in technologies and service models that can radically change the way humans on Earth interact with their environment, technology, and each other. These are some examples of companies we've already invested in out of Funds 1 and Fund 2 within this category. And then we've got one more category for you guys. Problem number 4 is that humans are squishy, which is great if you need a cuddle. Not so great if you're trying to go to space, right? And so keeping humans alive and healthy in space is really hard. It's really, really hard. To date, the longest stay aboard the ISS was about 1 year. I think it was 360 some odd days. This is obviously a pretty major impediment to Elon's future of humanity being a multiplanetary species. If we can't keep humans alive for more than a year in space, how do we ever get to that future? NASA, Roscosmos, and now the Chinese Space Agency are really spending a lot of time and effort trying to solve this problem, right? But the side effect of that is the medical breakthroughs that have come from learning how human bodies react to space have led to huge advances in medical science for people here on Earth. Everything from cancer drugs to artificial hearts to potential cures for Alzheimer's, asthma, cancer, osteoporosis, etc. Commercial LEO destinations, CLDs, or space stations, as we call them colloquially, are being designed and will be starting to be launched as early as 2026 to replace the International Space Station with commercial outposts. They'll have both government and commercial customers, but by far the largest source of revenue is predicted to be biological and life science experiments and manufacturing. And that's across the board with all the commercial LEO destinations. Every one of their business models relies on this portion of the business in order for the economics to make sense for a space station. Bullet point number 4 here is a human future. Seeking any technology or service model that can use the unique environment of space to improve the understanding of human health. These are some examples of companies that we've invested in within this category. Right now, because this is still very kind of early on in the game, you see that we've been investing in habitable volume, right? We've been investing in these commercial LEO destinations in preparation for them to start doing some of this biological manufacturing. Bonus points. Who doesn't like bonus points, right? Everybody likes bonus points on the exam. So the way you get bonus points with us is by working with the world's largest space customer by a huge, huge margin. The US government is the world's largest space customer. Some people estimate this to be 20%. Dan thinks it's probably closer to 75%. Somewhere in the middle is probably the truth that the US government is responsible for a huge portion of the economics of this industry. And so this is civil government and military customers, and they buy technology, data, and services. So it's not a requirement that our potential portfolio companies have government contracts, but it is very much an important part of our decision-making process. Getting that signal from the government customer that they are interested in buying your product really helps us believe that the technology has a future. And so even our consumer-focused portfolio companies typically receive one or more government contracts. And we can also help international companies integrate with the US government, either by becoming subcontractors of existing American portfolio companies or helping them set up satellite offices here in the States so that they can access this very valuable customer set. So quick summary, space infrastructure, at least 60% of the fund, and then beyond LEO, space for Earth, and a human future will round out the rest of the fund with those bonus points for working with the world's largest space customer. A little bit about SpaceFund's secret sauce, and then we'll wrap this up here momentarily. We help create value. That's our goal, is to not just set it and forget it like a lot of investors. They give you a check and they walk away. You don't ever hear from them again. We actually dig in and help the portfolio companies as much as we can. We like to get our hands dirty. We like to help the companies get that non-dilutive government funding. We like to help them raise up rounds. We do a ton of primary research. I'm constantly amazed when there's a fact that I know to be true, and I go to find a source to cite to prove that that thing is true, and there's no sources that exist. Or when I get into an argument with AI looking for sources to cite, and it keeps sending me back to my own website. So we do a lot of this primary research just to be a data provider about this industry, the economics, and what's going on. So we have several papers. One's being published in August, but everything is available on spacefund.com/intelligence. This is our market intelligence section. We also have our reality rating databases. As the person who is our webmaster, I can tell you the launch database, Earth to Space Transportation, is the most visited page on our website. We're currently tracking 183 launch companies around the world, which I think is a pretty stunning number that most people aren't aware of. And we're going through these different sectors of interest and cataloging these companies, and then we rate them on how real they are. That's why we call these our reality ratings. Dan touched on this briefly, but I think it's worth mentioning, especially in this kind of inverted pyramid funnel format. We're currently tracking over 4,000 companies. We've published reality ratings on over 600 companies. We've reviewed over 1,000 different space startup company deals, and we've invested in 21. It's effectively 2%. A little bit of advice on how to win with VCs, if you want to approach me and Dan or any other venture capitalist out there in the world, do your homework. Go to the website, read their blogs, read their Twitter, read their, X. Look at the existing portfolio, okay? One of the biggest mistakes I see people make is they'll see that there's a company in my portfolio that is a direct competitor to their company. And they'll say, oh, that means they're interested in this technology set or this solution set because they've already invested in it. Absolutely true. Know the math, that math that we talked about in those first few slides. Understand what your company's real profit potential is and do it within that 7-year time frame. Develop these relationships before you need them. One of our founders started having coffee meetings with me 2 years before he ever asked me to invest. And he took my advice and implemented it and came back 2 months later to the next coffee meeting and said, this is how it helped and this is what worked and what didn't. And so I knew that he was going to be coachable, which is really the number one thing, is you're never going to have all the answers. You're never going to have all the solutions. You're never going to have all the contacts. Be willing to take that advice. Be willing to be coachable. And that's one of the biggest things that we look for. SpaceFund.com. Thank you very much.